Good afternoon. I'm Tyson Halsey, founder of Income Growth Advisors. I've been in the investment business on Wall Street for 40 years. I won the USA Today CNBC National Investment Challenge. I've been in the Wall Street Journal, Barron's, and written over 100 articles for Seeking Alpha, and I've run a couple of hedge funds. I think today's market mirrors the 2000 tech bubble peak. We think that large cap equities are overvalued and bonds no longer offer safe, compelling returns. We think that from 1981 till 2020, a 4-decade period of declining interest rates and deflation, U.S. Treasury yields declined from 15.5% to 0.5% in 2020. In the 1990s, I ran a successful tech hedge fund, and we got out of the market peak in 2000. And after years of great returns, I found it very difficult to make money. I think the current period is analogous to the 2000 and 2011 period where equity markets basically performed poorly, but gold, oil, and emerging markets were places where you could actually make very good returns. We think we're now in an inflationary period, and we are rotating out of large cap tech and into gold, precious metals, commodities, value, small cap, international, and emerging market stocks. In the wake of the 2000 tech bubble, rotating to deep value commodities and geographies with solid fundamental stories worked extremely well. We think because stocks and bonds are overvalued, the whole 60-40 portfolio now is overvalued, if not obsolete. We think that you can get better income, value, and growth potential if you have a 25% stock, 25% bond, 25% commodity, and 25% cash allocation. We think this is particularly true for retirement accounts and retired investors. We recently constructed a $2 million portfolio for a retired investor that yields 7.5%, has value, international diversification, and we'll show you this at the end of our presentation. What I'm going to do now is go to our slideshow and share that with you. The Great 2025 Top and Rotation. Right now, one of the best models I've ever seen over the years is the Fed risk premium model. It says that right now there is very little reason to go into the equity markets. The last time it was negative or close to negative was back in the 2000 market peak. What this compares is the earnings yield of the S&P 500 to the 10-year U.S. Treasury. And right now, it's 0.58. A few weeks ago, it was negative. When the market is very expensive, for now, it's about 22 times forward earnings. The historic return over the next decade tends to be in the low single digits, let's say -2 to -3%. And another concern we have is that this market feels and looks a great deal like the market peak in 2000. And today we have a similar parabolic move like we saw in 2000, but now the Magnificent Seven, these 7 companies, their enterprise value is 62% of the gross domestic product of the US. Looking internationally, the CAPE ratio is almost 60, 59, and that's just insanely expensive. The US is very expensive, close to historic peaks at 33. But elsewhere in the world, the Argentina is 1, Brazil is 9, Hong Kong 11, China 14. This is very compelling to us. Another reason not to like the S&P 500 or the US market is we recently broke the 200-day moving average. Every major market decline is preceded by a break of the 200-day moving average. We've also seen a decline in interest rates for 40 years, and now they're going higher, and that's in part because we have inflation. We don't know that inflation is definitely going lower. We think that we've entered an inflationary cycle, and that typically follows stock market bubbles. And commodities usually do well in that environment. Gold and oil did very well in the 70s and also in that 2000 to 2011 period. During that post-bubble peak in 2000, we saw the emerging markets and international markets outperform the US, as we see here with the emerging market MSCI index versus the US. Additionally, sectors like energy, materials, mining, industrials, not tech, did very well also in this inflationary environment. So our kind of model portfolio, or what we think makes sense as compared to the 60/40, is this portfolio. We think of it as non-correlated income. And here we have 25% in gold stocks, gold ETFs, silver, but we do get a lot of yield out of some high yield ETFs and international bonds, some closed end funds that are high yielding, as well as high yielding stocks. We have some discretionary stock ideas and shorts for some flexibility, and we have about 15% in MLPs, though they're close to fully valued. They still add attractive income to somebody who's retirement oriented. If you'd like to learn more about what we're trying to do and how to outperform in the years ahead, where we anticipate the stock market will likely struggle, but money will flow now to deep value sectors that have been underperforming over the last decade or couple decades, please go to incomegrowthadvisors.com and sign up for our letter or sign up for a meeting. Thank you. My name is Tyson Halsey.